Well, good morning, everybody. Uh, Thank you for your time. We're going to be here. My name is Jim DePietro from CBRE. I'll be the moderator for the capital markets and investment climate part of the presentation. I'm excited about this because we have a really outstanding panel. And let me introduce those people to you. The first up is going to be Peter Mork. Peter Mork is the founding partner of Capital Partners. Peter is the second largest industrial owner in the Twin Cities. He's also a real local success story. I think Peter started back in 2011. He purchased, I think it was Westgate, for about a 53,000 square foot building, probably worth about $4 million. Today, 9 years later, portfolio worth, what, 8.2 million, probably just under $1 billion. I think I did the math, Peter, that's about a 75% growth rate. At that rate, in about 4 years, you will own all the industrial real estate in the multi-tenant market. Well, I'll tell you, the funny thing about math is you can make some predictions. Peter either will slow down or move to another market.
Neither. I'm going to keep pushing hard and hopefully buy out Link here shortly, Jim.
All right.
What about Florida, Morky? I could see you go down to Florida.
Good point. That's a good point. I do like Florida. Yep, Key West.
The next panelist I'm happy to present is Judd Welliver. Judd is Executive VP at CBRE Institutional Properties. Judd is also a member of our CBRE Corporate Capital Markets, focusing on sale leaseback of single tenant properties, built-to-suit financing. Judd, I have to tell you about Judd. Judd is, we often work with developers we bring deals to, and often the comment is, well, let me talk to Judd. Judd's kind of the go-to guy for a lot of people we work with, who is considered the subject matter expert when it comes to real estate investment in the Twin Cities. We're really pleased to have Judd here. Next up is Dave Berglund. Dave is a senior managing director and co-head at the JLL Capital Markets here in the Twin Cities, the number 2 firm in the investment market. Judd will tell you who the number 1 is, but Dave is a great guy. My one story with Dave I always remember is we were selling a multi-tenant investment market where the investor was out of town looking at the tenant, and this particular tenant was in the behavioral science business, where they were dealing with people that were in transition from prison life to work life. And he stood for a long time in front of the space and didn't say anything. And I thought, oh my God, there goes that sale. And Dave spoke up and said, oh, we have a robust, social service industry here in the Twin Cities, and this company does a great job. And the investor shook his head, great. On we went. Dave's been one of my favorites ever since then.
Got to sell her on all the issues, Jim.
Next up is Mark Kolsrud. Mark's been an active key broker here in the Twin Cities for 30 years. I characterize Mark as a big whale that doesn't spout very much, I guess. But I'll tell you, he has done some of the largest transactions in the history of the Twin Cities, and we'll talk about that in a little bit. So what do we talk about today? There's a lot to talk about, but the way we've structured the presentation is around a couple of themes. How strong is the market? The continuing strength of industrial. What are some of the factors driving it? What about rent growth? What about construction? What are some of the investor appetites? What are they looking for? What kind of concerns are investors talking to our panelists about? What's the impact of e-commerce and the look ahead? We're always paid a lot of money to peek around the corner to find out what the future can hold. In many cases, we don't have to be right in this particular panel, but we have to be provocative. We'll hopefully do that. One of the things I wanted to start with is a chart of, I'm putting this up as sort of a proxy for relative returns in the real estate market. And as you can see, if you look over at the year-to-date change, the parentheses mean negative returns. And the negative returns are pretty significant for hotel, for malls, for shopping centers. But what stands out when you look at these charts, the returns for data centers, industrial, self-storage, all essentially industrial real estate, are all positive, with industrial at 14% year-to-date gain. It's pretty significant. And I think one of the things I'd like to ask the panel to start with Dave Berglund, when the pandemic started, did you have any idea that the industrial market would stay this strong?
I think we thought that it was going to be stronger than the other asset types. Nobody really knows, like when you're heading into a pandemic, how it's going to really affect things. But we got the sense early on in March and in April with two large transactions that we closed that the buyers weren't holding back. They weren't retrading because of the pandemic. They were still, going forward. And also what we saw for rent collections with industrial real estate was quite remarkable. I mean, close, in the high 99% in April for rent collections for industrial versus, 90% or 89% for multifamily, which was also one of the darlings. So, from that standpoint, we could kind of see that the trajectory for industrial is just going to continue. Same with, the e-commerce stuff. I mean, as everybody's talked on the other panels before, e-commerce has accelerated that, and all the institutions are kind of gravitating towards, okay, well, our asset allocation towards industrial is growing because e-commerce is growing. We have a stat that over 50% of the absorption in 2020 is due to e-commerce, which lends itself to strong growth continuing into industrial.
I'll comment real quick on that because refer to a deal that you and I worked on together right in the heart of COVID. I would say I thought we would get back to where we were, meaning I thought we would get back to pre-COVID levels for capital markets quickly for industrial versus other asset classes. I did not think that we'd be sitting here today saying that we have new pricing benchmarks across the entire country for industrial. The depth of the buyer field is up, 150% from where it was pre-COVID levels. So I think we're all bullish on the industrial asset class, but I will tell you from my seat, I did not think we'd be sitting here in the fall of 2020, still in the depth of COVID, and we're seeing record-breaking pricing, new capital consistently coming to this asset class. And as I look at this chart here that you pulled up, I mean, this really just shows you that, there's so much unclarity in these other asset classes, and people are going towards, the space markets that they can confidently underwrite. Industrial is an easy one. You look at data centers, a lot of times those are long-term net leases with good credit supporting them, and then healthcare. So, it's not surprising to see that you look at, office, retail, other sectors, it just comes back to the unclarity in the space markets and the fundamentals of each of these asset classes. But go ahead, Jim.
When we talk about some of the rent collections and some of these other assets, like in retail, what have you guys heard for their percentage of rent collections? You're talking about industrial in the mid 90s. What do you hear some of the others, or what kind of numbers are they looking at?
Jim, I can speak, if you want, I can just quickly speak to rent collections on the industrial end of it. We've got 400 tenants at Capital Partners and 80 buildings. And, when this pandemic started, everyone was slowed down and take care of your buildings, take care of your tenants. And to date, we've only had 5 tenants, so 1.5% of our whole portfolio that ended up having to terminate their lease for one reason or another, but all related to COVID. And then we had another 20 tenants in the portfolio that we had to do some form of rent deferment, help them out, not give them free rent, just defer their rent until they got back on their feet. And so that is 6.5% of our portfolio was affected by COVID. And right now, I think our collections are 99%. So it's positive if you're an industrial tenant. If you're a retail tenant, office tenant, I'm sure it's a different story.
Mark, Kolsrud, I was thinking you transacted one of the largest transactions in the history of Minnesota during the pandemic. It's as though God said to you, Mark, here's this incredible opportunity, but I'll tell you, you have to do it and perform it in the middle of the largest pandemic in 100 years. And you have to do it when the state of Minnesota is shutting down its operations. And if you can do that, then you get the deal. So talk about that. What's it like transacting that kind of transaction in the middle of the pandemic when people had no idea how things were going to turn out?
I don't know what you're talking about, Jim. It was really no big deal. My seller had, was completely okay with everything that was going, and same with the buyer. We just closed. It was like Thursday. It was like nothing new. No, I think that really, I think it's important to work with people that you have trust and feel like they have integrity. And it really was a great testimony. That transaction to close nearly $650 million deal on April 9th. I mean, that was an answer to a lot of prayer, and I was pretty happy to see that happen. But everyone involved operated with a great deal of integrity and got it done. And the collection was 96% at that point for the rent for the portfolio, and so that the landlord was selling out of strength, and the buyer knew how to get it done, and so that worked well. But what's interesting going forward from that, we closed another deal last week that was supposed to close that same week, and it was in the 20-something million range, and that deal it was a portfolio of smaller bay tenants, and that had a little bit more trouble because the mom and pa was more affected by this. And so that industry, more of the cottage or that growth industry, that was a little trickier. And so we had to go get a different lender for that. And so I think it's both. And I think these investors offline, we were all talking, and this panel's full of smart people that all have a lot of good words on this. So I can't wait to hear all their comments on this. But I think the investors are experts at credit and experts at forward seeing where the rent growth is as well. So.
Yeah, I'll just add to that. I think during COVID, to get deals done, you had to be forward thinking about debt too. As we all know, the debt markets froze. I think all of us on this panel probably closed deals where people closed in all cash and had to get the financing once things settled down. So to Mark's point, people with integrity and people that are forward thinking, got through that. And now we're in a debt market that I think is better than pre-COVID for industrial real estate. So to me, I think a big part of the call it, 30 to 60 day pause was, figuring out the debt markets. And once those got figured out and rent collection, was good. We're here, we're at where we're at today now.
If we take a look at some of the factors that might be driving the rent growth, let me get that up. When I look at it in my career, I think I've seen more growth in the last 24 months than I've seen in the last 24 years. I mean, the old joke used to be, I don't know what the question is, but the answer is 8 and 4. Well, that's gone. That's gone. And if you look at some of the statistics we have, you'll see that the demand is really strong. Here's a graph of all of the existing active users that we track it in CBRE since 2008. You can see over 12 years that the line is moving up. 2020, 2021 is going to be the biggest year ever in terms of demand. You can see that the square footages, the active action is in some of the larger deals. So demand is strong, which is excellent. And if we go to the next one, you'll see that the rental growth has been strong every year. You can see that it just keeps going higher and higher. So my question is, Judd, when you're underwriting properties today, is it easier to underwrite 3% growth or 2% growth, or how are people looking at rent growth?
Yeah, I mean, obviously our job as selling these properties is to put the rose-colored glasses on, right? So, I mean, we always underwrite to the highest level that we can support. And in my career doing this, I've never had so many data points to support what we're able to underwrite now. There's a lot of drivers in that. Obviously you look at our vacancy rates, you look at the active users in the market, and you talk with people like Peter or Ryan Bartley, and they're looking at it saying these tenants have nowhere to go. So we can very much support our underwriting for rent growth. One interesting thing is, and we were talking about this offline, everybody on this panel, is in some cases we're getting better pricing when you have an average weighted lease term of 2 to 3 years versus an average weighted lease term of 5 to 7 years. And I would say that's more so for, second, third generation buildings. But if you have a, 15-year-old building that has a rent roll that is, a little dated in terms of when those deals got done, we'll get lower cap rates on a weighted average lease term of 3 years than we will 5 to 7 years. I would say that that's probably across the board with the exception of new construction rents, which are obviously pushing the envelope. And, then those investors like to see that weighted average lease term longer. But again, in terms of supporting rent growth, you look at Minneapolis compared to other markets throughout the country, we're a little late to the game here in terms of where, growing our rents. I think I just looked and we've grown rents by 26% in the last 5 years, but the majority of that's really been in the last 24 months. And you gotta point to guys like Peter and Blackstone and Duke and, all the major owners in town, and everybody's buying in and drinking the Kool-Aid. But again, we're a little late to the game. And that's why, we're finally starting to see a lot of new capital come to town. I still think we're undersupplied from a development standpoint because people have been reluctant to underwrite the rents that it takes and the cap rate exits that we're now proving out. So, I think we're bullish on industrial throughout the country, but as I look at Minneapolis, I truly believe we're in the early innings of what's to come here for owners and new investors coming to town.
Peter, we talked about 8 and 4 once as a normal. What do you think as an owner, second largest owner in the Twin Cities? What's the new normal? Is it?
Well, first, Jimmy, I want to go back to something that Judd was talking about. And of all the OMs I've looked at that Judd has put out, I got to tell you, the Prologis OM was the first OM that Jason and I said, you know what? We agree with this underwriting. I mean, it's always something to chuckle at when you look at those first off, but it is true. And exactly what Judd was stating, the last 10 years, you had that graph up showing there's a 4-cent increase per year in warehouse rates. That's like 1% annually. That's ridiculous. That's no more. We're going to see, I think, in the next, I'd say in the 24 months that we're experiencing, we'll see 75 cents to $1 increase in warehouse rates. $4 is no longer in existence. We bought the Midway portfolio. You could argue maybe class B minus, class C, infill 80-year-old property that we're putting a lot of money into it and turn it into a class B plus warehouse. But the fact of the matter is we've already done 4 or 5 deals in that product, and they have all been in the $4.95 to $5 warehouse rates. And if we can get $4.95, $5 in that product, every other product that has the fundamentals in place should have a 5 or more in front of it. And, the ownership has changed, right? 10 years ago, I think 18% of the industrial owners were institutional. Now it's with Link and their explosion in the Twin Cities and us, it's 65%. And we're different owners. We're owners that are closer to the market. I would argue closer to the brokers, closer to the deals, understand the fact that there's 10 million square feet of active users looking in this market today. And we've only had 200,000 spec built, and we only got 800,000 under construction right now on spec. Now that's going to grow. I'm sure Scannell is going to add a building or two, but next year we're going to have 2.5 million square feet of new spec, multi-tenant spec, and we've got 10 million square feet of active people looking to expand. So what does that mean? That means rents are going to go up. They're going to have to renew most likely, and we understand that. So we're going to see significant rent growth.
When I look at this chart of new construction, what strikes me is that over 50% of all the construction is build to suit versus spec. You guys see that more of a trend where that corporations, because of the rates and that might continue, or do you think they'll move more towards spec?
Yeah, we lag the rest of the country on spec development. We have much less than in other similar sized markets like Denver. So, the fact that we're going to maybe see some more spec development happen, in 2021 is probably a good thing for our market. There will still be build to suit, opportunities out there, and those transactions will happen. But as the demand, continues to rise and our vacancy remains, pretty near all-time lows, all, this, the build to suits will continue to go. And we think that all the spec projects that are going to happen are going to see success and continue to push the rent, like what Peter's saying.
Dave, just a comment on that. I mean, don't you think build a suit to lease for sure? But if someone wants to go out and do a build a suit to own, these developers aren't excited to go sell their land and just get a land fee and a developer fee. So if you want to do a build a suit to own, you're going to have a challenge, I think, finding a good location that a developer who has worked hard to control is not going to do spec construction on it because
they'll just charge for that build to own like they would build to suit is what they're going to have to start doing. Yep. One comment on your comment, Dave. So across the country, if you look at these high growth markets, like you referenced Denver, they're typically 1/3, 2/3. So 2/3 spec, 1/3 build to suit. Minneapolis has historically been more 50-50 and even a greater weight towards build to suit. What's interesting, we're doing a national platform equity raise in 3 markets across the country. Just with this land that's under control right now, we already see 1/3 of that portfolio going build to suit just because they control the land. So I think Minneapolis needs to kind of expedite our spec development and catch up with some of these other high growth markets and be bullish on it. But I think the build to suit market, if you can control good land, is going to continue to be a common theme. The other thing about our market is you get these, unique users. We're working on something out in Woodbury right now that's going to be a huge basis, medical device, build to suit. And so, those are deals that you just can't make sense of doing on, building a spec building and having a med tech tenant come into your spec building and lease, 1/3 of the property or 2/3 of the property. So I think Minneapolis is a little bit unique because of our medical device, our higher finish, lab space, clean room space, where build to suit will always be a big factor here, but I think we could step on the gas with spec.
Well, that's interesting. Out of the 30 projects here that we identify, only 10 of them are spec and the other 20 are build to suits. So what you're saying basically is that this might flip.
I'm not saying it going to, I'm saying it should, meaning that I think if developers have good land positions, no need to wait.
Right.
Yeah, our market can support more spec development, I think, is the bottom line.
Yeah. We just don't have the spec developers that we had in the years past. The Gary Holmes, the John Allens, they're gone. It's Skinnell, Budish, Opus to a small extent, and then it kind of falls off.
Good. In terms of investor appetites today, I know you have a very large portfolio in the market for Prologis. Can you talk a little bit about what you're hearing from investors in terms of their appetites, to where they're looking at this portfolio, and how does it with other portfolios around the country from some of your colleagues, and where does Minneapolis sit? How do they look at the Minneapolis market?
Yeah, good question. So, before I talk about Prologis, I'll just say that every deal, obviously we got a little bit of a logjam coming into the summer. I think our team has launched 15 plus deals in the last 90 days. On every one of those deals, we've exceeded pricing expectations, and the depth of the buyer field is as great as I've ever seen it. And that goes for every asset class, whether it's a Class B deal. In fact, we're selling Peter a deal Egan right now that his partner on that had to switch from a value add bucket of money to a core plus bucket of money just because pricing changed throughout the process so drastically. So I would say across all offerings, whether it's a $10 million B-ish deal to a net lease deal in an outlying location, everything is the best I've ever seen in my career. The Prologis deal is interesting. It's eye-opening because this is the largest fully marketed Class A portfolio in town. Obviously, Mark did some monsters over the last couple of years, but different seller profile, right? Where they wanted to keep it top secret and keep it under the radar, whereas Prologis needs full pricing discovery. So we did a broad launch with that. And one thing I've noticed is that, that size is taking out a lot of the traditional core industrial investors in town. So James Campbell, TA, Cabot, it's just too big for a lot of those groups. So we're seeing a tremendous amount of new capital that's exploring Minneapolis for the first time because they never had an opportunity to get size and scale in this market. So it is a bit of an education process, right? So we're having to explain the Rogers market. We're having to explain, the finish levels. We're having to explain the eclectic tenant mix. But overall, the feedback has been extremely positive. I think people view Minneapolis as a very high quality market to get a good risk adjusted return and what is considered to still be a high growth market. But it is an education process. And I would tell you, it's all new capital after, a certain, couple names. It's not going to be the typical people you see on the bid list, the Stags, the TAs, et cetera. It's likely to be new capital would be my best guess now. But it is an education process to get new people here, as Mark and Dave know, but it's fun to do. And we think we have a great story to tell.
Yeah, you basically have to be a teacher, in our industry. It seems like you pick somebody up at the airport and then you say, okay, now this is how the town works. And Minneapolis isn't the same as a lot of other towns. And for all these years that I've been doing this, I'm a significant fan. I'm a great fan of how our city works, but it isn't the same as, kind of like what Judd was saying, and these investors, they compare our sales to other sales and they use cap rates to do that. But, I don't think anybody's buying because it's the cap rate. They buy on a return, of course, that's either a 5 or 10 year return. And that's where the debt influences as well. And that's where we think that we're really going to see some more rent growth, and we're going to see new and old names that are going to come and figure this town out. And it's kind of exciting. It's like a page turner in this town's experience. So.
That's interesting. All right, let's look ahead, peek around the corner. Here's to the audience. I'll give you some insight here that CBRE does a weekly take on a podcast with our head of research, and they recently interviewed the author of Rethinking Real Estate. And I highly recommend you listen to it. It just came out a couple of weeks. I think it came out in August, but talking about the trends in the industry. And one comment he made that I'll leave you with is that he said, we left the 20th century when we left work in March of 2020. And when everybody returns back in 2021, we'll be hitting the first step into the 21st century. So there'll be a lot of changes to look ahead. But as we look at the impact on commercial real estate here's a chart of the top owners of real estate. Link is 13.5 million square feet. Capital Partners, 8.2. Duke, Artis, Stag, First Industrial, it drops off. Prologis, 2.5. And Judd, I believe that portfolio is on the market with you. What's likely to change going forward? You guys see more, Peter, do you see more consolidation?
Yeah, I do. I think that, and we've got my 3 favorite best friends in commercial real estate on this panel with me that I go to day in and day out to see what's coming on the market and what opportunities are there for capital partners. And you look at this list, and I think certainly Link has been very active. I think they need to slow down a bit in this market, and hopefully they will. And Duke, I think, is slowing down. Artists, I don't think will do much more. Stag's a single tenant industrial buyer, so they really don't compete with a lot of people. First Industrial, as Judd mentioned, we're buying one of their buildings right now. They're kind of slowing down. Travelers has stayed the same. Onward's active, and UP builds great bulk and usually flips it. So I think
Peter, go ahead. Sorry.
Yeah, I think there'll be some consolidation, but there's got to be some new players coming in this market. And what Judd mentioned, I think we're going to see it with this Prologis launch. It'll be very interesting to see who ends up getting that.
The one thing I would say, Jim, is as you look at the profiles here, and Mark alluded to this earlier on hold periods, you look at the depth of this list, they're cash flow driven versus IRR driven, right? And so you've got Onward and Capital Partners that are operating platforms for institutional capital that are driven by a promote. And so those hold periods are going to be a little different because those IRRs are going to erode the longer you hold. Link is a little bit of an in-betweener, right? They've got some long-term hold and some IRR driven deals. But, a lot of these groups are long-term holders is a common theme. So I think it's the list after this that will change more than now. You know, as you look at the top 25 groups, there seems to be more movement there than there is up here. Now, you never know what can happen with some of these REITs, right? Like Duke or Artist REIT, who's very exposed in other asset classes. You know, First Industrial, they could just decide to pick up and leave the market like Prologis is, but it's not because they're trying to get a promote or trying to close out a fund. The depth of that buyer profile is on another tier. Again, the TAs of the world that are saying, hey, we have a 7-year hold period. Regardless of how much we love the asset, we're going to close out our fund at that period of time. So that's something I've always recognized in Minneapolis is, you know, this list right here, there's not a whole lot of what I'd call IRR driven owners here.
The other thing that's really good about this list is that I think other institutional capital has seen Link invest so heavily in our market that it opens the door like, hey, what are we missing in Minneapolis that these guys seem to be capitalizing on? So I think that that's like going to bring more institutional groups into our market, and whether or not they're a REIT or, you know, pension fund or other types of sovereign wealth groups, I'm thinking that this list will continue to evolve and new capital will continue to come in because Link's position here. And Link, you know, like Judd said, they're an in-betweener. You know, that part of that, you know, part of their portfolio is in different funds that are either long-term versus a little bit more short-term. So we could see them exiting out of, you know, certain stuff in the future, and then that changes the profile of investors that are here, you know, too.
Judd, when you talk about an IRR buyer versus a cash flow buyer, can you explain to the audience what that means?
Well, I mean, simply put, if you look at the REITs on here, Duke, Artis, Stag, First Industrial, Prologis, they're all thinking about paying a dividend, right? I mean, that's where a big part of their focus is. And whereas a lot of these other groups are, you know, and again, I would say the next tier of groups outside of, you know, what Peter's doing is they're looking at, you know, a short to medium hold period, where there's a little bit of meat on the bone usually with what they're doing. They go in, create value, and harvest that value, versus just thinking about, you know, monthly income and paying dividends. So, you know, the IRRs are, you know, I would say they're overused a little bit in our market, in our industry as a whole, but that IRR is what drives all these funds, all these JV partnerships. That is really the meat behind how the money's made with all these partnerships and funds and whatnot. And Peter, you know, has kind of led the charge in this market in terms of tapping that capital and getting in and knowing how to create value. But, you know, that's what they're underwriting to versus paying their investors a monthly dividend check.
You know, when I look at the chart and I see the concentration, I think, you know, when you think about the total market for multi-tenants, about 155 million, and between Link and Capital Partners, you know, that's close, it's over 10%, closer to 15%. And of the functional real estate, the real estate that's the kind of real estate that corporations can operate in, my guess is it's almost 20 to 25%. Do you think that's part of the driving some of the price power that's moving things towards where the prices have to be, or what's your thoughts on that? Mark, are you seeing that? You think that has much of an influence or impact?
I'll be honest with you, I wasn't listening to what you were saying. I was checking my Facebook, Jim. No, I'm kidding. Just felt like it got a little sleepy there. So I want to go back to some of that other comments as well. You know, one of the things that I think we're, as we talk about the returns and IRR and all the math that goes into that, you know, I think that we have to really look at, and you talked about consolidation, you know, how did it happen? The list that you see there in this on your screen, how did it come to be that those are the people that own it? Well, I think we're going to see even more consolidation with that. So the market builders that United Properties and Opus and some of these others, their speed to resale is going to increase. And I think we're going to see other groups like Peter Mork's company have interesting and new capital. And then we're going to see some of these bigger groups buying other big groups. And so all of these REITs are for sale at some level, at some price. And so with that, I think we're going to see the city kind of wake up to the new, to a new market, and we're not the little town in the north anymore. We're a dynamic commerce, and it works. Our commerce works here, and so I think there's going to be cash flow buyers. There's going to be, long-term holders. We're going to see repositioners. We're going to start to see some of these broken buildings that are, kind of in need of institutional capital come behind them, do a few things to them, and bang, they're going to, pop like what Peter's doing in the Midway with that Midway portfolio. So that's the exciting part of it. I've done this long enough to see a couple of the cycles, but I would tell you, I've never been so excited over the next 5 years of what this city's got coming to it. So,
Wow. Both you and Judd and Dave and Peter, I mean, the optimism is intense. Let's talk about the going forward. Here's an example of the impact of e-commerce. Duke did their Park 81. The interesting thing about this building is the amount of delivery trucks in queue, the amount of land that was needed to support a building like this. Very, very difficult to provide. I think if you look at the e-commerce, the search for larger and close-in facilities, investor demand, what impact, I mean, how often does Amazon come up as influencing what's happening in industrial real estate? Are people concerned? Is there an Amazon effect? Has anyone noticed anything to that effect? Like, does some people ever look for diversification from Amazon?
Yeah, definitely diversification. I mean, in the last probably 6 months, I think I've heard more about diversifying from, for some of the larger institutions, diversifying from an Amazon allocation in their portfolio. So, some don't have enough, right? They want to get more, but there's a big audience out there for non-Amazon credit tenants. And sometimes in some cases they're seeing more attention or even more depth to the buyer pool for non-Amazon credit tenants that are still, considered investment grade. But, certainly there's going to be a depth for the Amazon stuff. And it seems like what we've been hearing on all the Amazon transactions around the country is that there's several, the buyer pool is big, but it seems like a lot of that capital is coming from similar type areas where we've heard of a couple of transactions where the top 3 or 4 bidders for the prospect were an operator that were all chasing the same capital source. So it'll be interesting to see how that affects everything. But in terms of credit of tenant, yes, Amazon is very desirable and you can sell an Amazon, deal any day of the week. But some of these different credits and different industries still have a huge buyer pool towards them.
I think the key to that is Dave's mention of investment grade credit. So you're not going to buy an Amazon one day at a 4 cap that has an A-rated credit or AA, whatever it is, and then the next day go buy a building right next door to it with sub-investment grade credit for the same yield. I agree with Dave that I think if you have quality investment grade credit, in some cases we're seeing a deeper buyer pool for, for example, my colleagues just sold a big DC that was had a long-term lease with Target in it. We're working on a couple Lowe's build-to-suits with some developers across the country. And I agree that it's kind of, we talk about Amazon every day, all day, every day. And I think it is nice to, it's a good point by Dave that layering in some of these other investment grade credit groups that are doing the same thing, right? They're all Home Depot, Lowe's, Target, they're all building these for the same reason Amazon is. And in some cases, people like that diversity. But it has to be investment grade credit. Otherwise, you're talking about apples and oranges.
The other interesting piece of that is cold storage. We've seen a huge demand in cold storage, facilities as well. So, we had a Coca-Cola facility in Florida that a team down the south was marketing, and people were just capital was jumping over each other to buy that just because it had Coca-Cola credit. So it's investment grade credit. And it was a cold storage facility, which seems to be another driver in the industrial market, aside from e-commerce.
What's interesting, if you look at the impact that retail online sales are 15%. With 15%, look how they totally disrupted the retail world, right? And if the stay at home, work at home impact, if 15% stays at home after the markets or the offices open up again, look at the impact we'll have on office. And the way the world is changing in terms of the different uses for real estate. One area that I find pretty interesting is we've been talking a lot on a national level about the impact of some of these larger retail facilities being used for fulfillment and e-commerce industrial applications. And I know, Dave, you've worked on the Brookdale Mall. Talk a little bit about that, what you found there and what's going on and how that might be a trend that people can think about for the future.
Yeah, Jim, you're talking about the Sears in Bergland Center, right off Highway 100. Yeah, we got hired to sell that, and the city said, they wanted to see industrial there, and we didn't really widely market it, but we got 10 offers on it pretty easily, and they're all very, very competitive, and everybody kind of is jumping at that opportunity. And that's an old Sears that is dilapidated and can't be reused, needs to be torn down in a retail trade area where retailers don't actually want to go, but industrial users would probably view that as an infill site. So developers have latched onto that and are getting pretty aggressive. Some of the developers on the last panel were all chasing that deal. So it'll be interesting to see how that goes. But I think there's a lot of opportunities like that where you get these dark boxes, whether it's a Sears or something like that, that is going to be transformed into some sort of industrial just because they're well located.
I know at CBRE, we've kind of merged our industrial and retail leaders together because we see this melding of potential uses and people having the same needs. It's pretty interesting. And I read somewhere where Walmart is looking at hybrid stores now where they combine warehouses with retail outlets. So there's a lot of change taking place brought upon by this. As we finish up here, I want to just get to the last point, some final thoughts from the panel. One of the things that I always, we've been extremely positive in this presentation. Are there any things out there that keep you up at night? Peter, I know you're a man with a lot of courage, with a lot of determination. You work hard. You're very positive. The best is yet to come. Are there any?
Thanks, Jimmy.
Absolutely. And I think all the audience, if they're young people out there, it's still possible if you work hard and you have good character and you work hard again and again, you can accomplish what Peter's accomplished because he started pretty much, right at the, I don't think anyone was there to give you a helping hand except for your own efforts. But what are some final thoughts about things?
Thanks,
some
Jim.
people
Yeah.
talk about this as a K recovery, that some half of the groups are going way up and the other halves are not going up. We're fortunate enough to be dealing with the people on their way up. Peter, what are your thoughts on that?
I guess my thoughts are, Minnesota is blessed with, 16 or so Fortune 500 companies that kick off a lot of great small incubator type businesses that seem to really help push the demand for flex product type in the Twin Cities, which has always done well. And we've got a great education workforce. We've got wonderful universities. We've got a highly educated workforce. And we got a great, we have a great lifestyle here, right? We got the lakes, we got the cities, everything's great. What I worry about though, is I worry that, quite frankly, that our local and state representatives are gonna keep pushing some radical legislation initiatives that are gonna scare away institutional capital from coming to a market like Minnesota. They hear these things about defunding the police and.
All right, I'm gonna have to cut you off, Peter. You can't.
I agree with Peter. I think that's not to get into, it's not political. It's just, let's keep our city safe.
Yeah.
Judd, what else from you do you think, is there any? If you have forced to look at.
I try to not think about things I can't control, but I think that our industry, if you think about the Great Recession, every asset class kind of went like this and like this together. this time it's all shooting in different areas. I am concerned about our industry, and if we do have some major distress in retail or office or multifamily, I don't think that industrial is going to have distress. But if everything falls out around us, the lenders, the equity investors that have exposure in these other asset classes, could cause some pain. If you think back to the Great Recession, you can point to, the one major thing that brought us down, that was the housing industry. But everybody owned a house, and everybody's net worth went down substantially just because they owned a house. I'm hopeful that any distress we have in other commercial real estate asset classes won't impact industrial, but I do think that a lot of people have exposure to these other asset classes, and that will affect how they look at industrial. Short term, it's had a positive impact.
How about you, Dave?
I think the only fear would be, kind of to touch on what Judd mentioned a little bit, is like interest rates and the debt markets, right? Through the last recession, the debt markets really disappeared. They only disappeared for a little bit, at the beginning of this, and they came out roaring back pretty strong. And we've seen really good debt quotes on, every asset that we've sold or brought to market. So, hopefully that continues. The other thing is, and we didn't really touch on this as a panel as much, but we have seen good cap rate compression. And what that's going to ultimately, and we've seen good rent growth. So, you talk about inflation and you talk about rent growth and cap rate compression. Well, that goes on the other side of the price per pound issue, where, our market has always generally had a little bit higher price per pound. So just, educating investors that, paying a little bit more on a price per pound basis is okay. And as you see more product being built, those with higher rents, just like the Opus deal, that's going to be a higher price per pound trade. And that'll probably continue. So we'll just need to see more data points. And I hope that we do see more data points to help that part of our industry on the industrial side.
Mark, I'd like to hear from you. And also, how are investors positioning themselves for 2021? What are they thinking about or worried about, or what do you hear from them?
Well, yeah, I think that's a good way to land the plane. It's, as we think about our market, my team, we have 2 significant portfolios we're going to be coming out with after the first of the year. And then we have a number of smaller portfolios as well. We're just kind of watching what's happening. And we're seeing there's 2 portfolios out there right now that everybody's paying attention to. And I think we're going to see glass ceilings broken for that price per pound. And we're going to see new capital. We're already, we're constantly hearing from new capital sources that want to be in Minneapolis. And it's going to be a gear shift. We're going to start to see some of the groups that own portfolios here saying time to tap out. Then if that's the case, if they can sell that for that price, let's go. And I think we're going to start to see even more volume and more opportunity for new investors coming in that don't mind $145 industrial buildings. And so I think that's kind of exciting as well to see that change. And as we move into the market, the rest of the country has experienced, because, when we've seen land in California selling for $75 a foot, I mean, you put a building on that, it's crazy math. It's Disneyland. Well, that's California, Disneyland, right? And so that's kind of where I think, but I also think, man, if our country shuts down for 6 weeks after the election, I mean, after all this is settled down, and we put the lid on it and we put nails in the coffin in that way, there's going to be some people that just have great businesses that just don't survive in spite of everything that they do right. And so that's the part that keeps me up at night.
Do people worry about inflation? Do they look to this as an inflation hedge? I mean, it's been a long time before we've seen any real inflation. Is that in the investor dialogue?
Well, I think the investors are all looking for increasing returns, right? And so inflation times, there's some good news in that and some bad news in that. There's some people that are starting to, have their investments and then they start to increase their returns in those investments, and others, it's kind of a barrier to entry. And so I just think that And then the other thing that we're going to see is, you know, if things continue to go the way they're going with a slowing economy by the government controls, we're going to start to see people be really good credit experts. We're going to start to see everyone really knowing about credit, really understanding what that company does for a living and why they're going to, you know, weather through this next 24 months.
Interesting. Well, I think that concludes our program. We have a time for questions, I guess. Is there any, oh, I see one question to the panelists. How well is spec product actually leasing? It seems a little bit hit and miss, especially with the build-to-suit deals absorbing a lot of tenant demand. Is that an accurate statement?
I think buildings are leasing well. It depends, you know, a lot of the tenants aren't experienced with the new rents, and they're having to get taught on what the new market rates are. So.
Yeah, name one failed speculative industrial project. I mean, I suppose you could point to some in Rogers, but you know, besides that, name one failed industrial spec project. I can't.
It's just the opposite. Look how well Opus has done with what they did in Mendota Heights and Eden Prairie and what they got going up in the Golden Triangle. They're going to hit it out of the park. And that's what needs to be done.
So really, the exciting thing is this market, a lot of new product, a lot of new activity, a lot of new entrance to the investment side. It's going to be, is this going to be the roaring 20s after the pandemic? People talk about, look out, once we lift the blanket from things, this thing's going to be the roaring 20s of again.
Yeah.
All right, guys. Well, thank you very much. I think we have concluded.
Jim, thanks for your hard work.
Thanks,
Thank
Jim.
you.
Great
Thanks,
job.
guys. Thanks, Jim.
See you guys.